When it comes to life insurance sales, there is definitely a problem that exists among selling life insurance policies to high net worth individuals. What often happens is a licensed agent or perhaps financial professional will meet with a family that is worth, call it $100 million. They're recommending life insurance to the family, mainly for estate planning purposes, because they have a high net worth. A lot of their money is going to go out the door to estate taxes. What happens though, which is very unfortunate in the industry, is agents will speak with other agents when they are working on the plan design and set up a life insurance policy that 100% prioritizes the death benefit, meaning the client pays a very large premium, could be 6 figures per year, could be 7 figures per year, and they have a very small amount of cash value in the first year, and it takes a long time to build up any real value. Think of it this way. You pay $1 million per year, and in the first year, you have 0 in cash value. Somebody just showed me an illustration for a young person that was being proposed almost $8 million per year in premium. The death benefit was more than $150 million, and it was set up for the highest commission design with that particular product. Very low cash value up front relative to that $8 million premium payment. My point is, these types of sales often occur because agents talk among themselves and will state things such as, well, this person has a high net worth. They don't need the cash value here. The purpose is death benefit, justifying the purpose or the design of that life insurance product and how it's sold. Here's my issue with it. If that's me and I'm the uneducated consumer, because cash value life insurance is confusing, if you sell me a policy where I put $1 million per year in and I have a low cash value up front, and then I find out after the fact that I could have had that same product with the same company, same life insurance amount up front, more life insurance long-term, and had all of my cash value up front and more long-term too, I'd be like, what the heck? Why didn't you show me that? Yeah, I might not need the money, but I still want to have access to it because it's my money going into a policy. That's how I'd feel. The problem is, it was never shown to me. So what we're going to go over today is what to look for with a whole life insurance policy. And we'll focus on some fairly large policies that I've seen, maybe it's just of late, but I feel like people that are high net worth are being proposed these life insurance policies that are not good. And the perception is just, well, they've got the money, so they don't really need it here. It's for a long-term benefit with the life insurance payout. Like, no, what if that was you? Like, if you can have both with your cash value up front, why would you not do that? That's what corporations do. They've got the high death benefit up front on their employees because it's key man insurance, and they have the high cash value up front because it's an asset on the balance sheet, and they have a lot of cash value and death benefit long term. And the thing is, you can use products that are available to most corporations for individuals. You just have to be willing to design it that way because as an agent, you will make a whole lot less in compensation. So let's take a 45-year-old individual, okay? So we've got someone who's 45 years old. We'll assume that he is going to purchase a $10 million death benefit, or this is going to be sold to him. The cost might be $200,000 per year. That is the annual premium. And this type of setup will prioritize life insurance first because they'll have a $10 million death benefit, but cash value second. In the first year, you'll see 0 in cash value, or a very, very small dollar amount available in cash value because I'm just buying a life insurance policy. So the thing is, when we see this a lot, you can fix this problem by reverse engineering a policy. So first, let's look at the problem because it definitely is a problem. Here we go. You can do this with any company. Here's an example with a major mutual company. What we have is just a traditional old school life insurance policy where he is paying $200,000 per year. So here's his $200K payment. It is all going toward the insurance premium, nothing going toward our paid up additions rider, which is how we grow the cash value. and the first year cash value is 0. You would be so surprised about how many people are sold policies like this and they don't question the agent at all. They just accept it because they're told this is how it is. It's a life insurance policy. I just pay whatever the premium is, and I eventually see this cash value build up over time. So what he gets with this is an immediate death benefit valued a little bit greater than $10 million, and it appreciates over time. So in this example, he's going to pay into it until he is 65 years old. He's paid in a total of $4 million. He has 5.2, so he does have some appreciation on it. And the death benefit's worth about $14 million, and then it continues to appreciate over time. If we look at it, he pays nothing in, and it keeps on growing. So it does grow over time. However, the upfront cash value stinks. 10 years in, he's paid in $2 million, and he has $1.6 million. Like what? The break-even point is right around year 14 when we look at it, just to get his money back. So here's what many people are not aware of. You can take that exact same policy and reverse engineer it. So what this means is we're going to minimize the upfront death benefit, but then you will see that death benefit grow as the cash value grows. So when we say reverse engineer it, we're not going to say it costs this much. Instead, we can say the funding, we want to match what we were shown before, that $200,000 per year. So if I want to fund 200K, I'm going to pay the exact same amount with the same company and same product. I'm just going to choose where the money goes. Instead of putting the full $200,000 toward the base premium, which is what we saw in the first example, we're going to put $20,000, which is very close to the minimum we can put toward the premium there. And then $180,000 toward our paid up additions rider. And what this does is, from a short-term perspective, it gives us a lot less in life insurance. But from a long-term perspective, you'll see more in life insurance. The reason why is because the policy that has the most cash value long-term will also have the most death benefit. Here's why. When you look at a life insurance illustration, if you go all the way to the bottom to age 100, with some products it'll be age 121, you'll notice that the cash value and death benefit are equal to each other. So the policy with the most cash value is naturally going to have the most death benefit. Typically, when we are in our 80s, which is around the time an insurance company is expecting us to kick the bucket, is when we see this high cash value design not only have the most cash value, we'll see the most from start to finish in terms of cash value, but also have the most death benefit. So let's take a look at this example, and then I'll show you how you can do both. So here's the first example we looked at, what not to do. Let's take a look at the same product with the same company, but what we're going to do here is design it for cash value first. Do you remember what your cash value was in the first example? It was 0. So here we go. Exact same product, that whole life 100 product. Same out-of-pocket to you, $200,000 per year for 20 years. The difference is up here is your base premium. $20,000. That's literally 1/10 of what we saw in the last example. The rest is going toward PUAs. We've got a term insurance rider attached as well. But here's the big takeaway. You pay in $200,000, and instead of a 0 in the first year, you've got just about $170,000. So you've got a ton more in cash value with the same company and same insurance product. Now, the trade-off initially is the death benefit. It's less than half of what we saw in the last example. Initially, As time passes, you will see not only more cash value, but more life insurance as well. By the 20th year, you're at $14.3 million. Let's take a look at these two side by side, shall we? So here's the first one we looked at, the example of what not to do. You pay $200K per year. Of your $200K, all of it went toward the base premium. Compared to the second example, here we go. What do you notice here? Only 10% went toward the base premium. For you, it's the exact same out of pocket. You pay $200K per year. The cash value difference in the first year is what the cash value is in the example to the right, because I had 0 in the first one. But look at year 20. Cash value in the first example, $5.2 million. Second example, $6 million. You've got $800,000 more in value. You've got a lot more money in the beginning because we designed it for cash value. That's also an opportunity cost. And the death benefit. By the 20th year, we also have more. Check that out. Now, as time passes, we see the death benefits are very close between the two, almost neck and neck, but eventually what's going to happen is the example to the right is going to pull ahead, where not only do I have significantly more cash value, but also more death benefit, which is interesting, isn't it? Now, sometimes what one might express here is, what if something happens early on, where I need a $10 million life insurance policy in place? I don't have it here. There's two options. One, you can supplement it with a 10-year term policy. What I could do, if I need this to hit 10 million, just add a term policy for about $5 million. It could even be set up to be decreasing term, where I could just decrease it as the years pass. This way, I spend less and less every year. That's probably the most cost-effective option. Or you could do that with a whole life insurance policy. Here's what I mean when I say that. You can add a term insurance rider, which we're going to do here. And the term rider is going to decrease as the whole life death benefit increases. Okay. So, what we've got here is both. Our total death benefit is going to be $10 million. What that will consist of is a whole life death benefit of $1 million. As you add money to your policy and the cash value grows, that whole life death benefit is going to grow with it. And as the whole life death benefit goes up, the term rider is going to come down. So when we go back to this example, what do you notice about the death benefit in the first year? It's $10 million, a little bit higher. What do you notice about the cash value? It's 157. In the last example, it's about 167. So adding a term insurance rider this big for more than $5 million does cost about $10,000 in the first year. Now granted, I've got a whole lot more than 0, right, which is really nice. And I've got the death benefit that I'm looking for. So we can scroll down here, but to make it easier, let's do the same thing we did before. Here we go. A lot of spreadsheets. So this is the same 10% premium, but you've got an added term in here. So the PUA piece is actually much lower than 180. Let's call it 165 to 170 because we have more money going toward the term here. But it gives us our death benefit and richer cash values up front. If we look at it by the 20-year mark, there's the most common type of whole life insurance product that is sold, lowest cash value. Here's the product that was designed for maximum cash value from the beginning. And then here's the middle of the road option. Much stronger than the example to the far left, but not quite as strong as the example in the middle. Are your payments any different? No, they're exactly the same. Item to note here, the column in red, the base premium. That would be our minimum commitment. A lot of people we work with like that flexibility where we'll set it up where they can commit just to the minimum premium and add additional funds toward PUAs at their discretion. The big takeaway is I've got more value from start to finish when I design it correctly. That's it, which means reduce the insurance expenses, reduce the commission. This is why people get pushed back or are not even shown this all the time, and maximize the cash value. What I want to wrap up with are two different versions of products that are designed for high cash value. Here we go. So these are limited pay products, referred to as 10-pay policies, one with Guardian and one with Mass Mutual. Guardian I used because if I'm targeting a certain death benefit, their particular design, it's a bit more accommodating in my opinion. So we could target a $10 million death benefit and have decent cash value too. It's not great, but the break-even point is between 6 and 7 years. By the 6th year, I've paid 1.2. I have close to 1.2. By the 7th year, I've paid 1.4. I have more than 1.4 million. This example maintains my life insurance amount of 10 million indefinitely, and the cash value continues to appreciate over time. And I don't have a zero up front either. And I'm not told that I have to pay more in either. Now you could, some people will do that to stuff the cash value, but keeping all things equal and reducing the funding period, now I've got a product that is specifically designed for a high cash value, which will give me more death benefit long term, to also accommodate the life insurance policy I want. And lastly, if someone said, okay, I like that and all, but man, I want to get as much cash value as possible, well, then I would absolutely juice the thing and do something like this, where here we've got a $20,000 base premium. This is the same as the Mass Mutual examples you saw with that Whole Life 100. This is just their 10-pay policy, which is the opposite of the Whole Life 100. The Whole Life 100 is designed for death benefit first, cash value second. This is the opposite. So the first year I pay in $200K. I've got just about 90% of that. 90% of 200 would be $180,000. You're at just about that. And this is a select preferred, so second best health rating. So I fund that. Look at this. By the 4th year, I've paid in 800 and I have 800. By the 10th year, paid in 2 million, I have 2.4 million. The big drawback to this is the upfront death benefit. You're at 2.6. So if this didn't work for someone because it was a serious estate planning case and they said, hey, we need the insurance in place, I'd probably get some term to supplement this if they really liked the if they really liked the cash value growth, because check this out. So as time passes, I need close to a 30-year term. By year 30, cash value, 7 million and change. Death benefit, 8.4, almost 8.5. If I look at my 80s, right around expected mortality, when the insurance company thinks I'm going to kick the bucket, my death benefit has also appreciated. And this is a design that prioritized cash value. What's cool about this is if we go back to the Whole Life 100, we funded that with $200K per year for 20 years. The death benefit by 85 was what? For the all base premium example. Not too much higher than the $12.5 million. In fact, let's wrap up with this, because this is where people's eyeballs kind of pop out of their head, as do mine, because I'm like, how are people just like not ever shown this stuff? As we look at this guy, this has a similar design, or this is a different design. This is 10% PUA, or 10% base premium, 20% PUA, and only funded for 10 years. There we go. Pretty cool, huh? So by year 10, cash value, 2.430. Here's the actual illustration. There's your base premium at $20,000. There's your net cash value at 2.430 at the 10th year. Okay, so I look at this by age 85. All right, there is a difference. But really, when I look at it, I've paid $2 million less into this policy. And the difference there, I'm closer than $2 million with that gap. And this is over a 40-year time period as well. If we add a rate of return here, you will see a big, big difference in favor of that 10-pay policy. My point is, it's just being shown the different options and having the knowledge, because where people have buyer's remorse is when they don't know. They get a policy and then find out after the fact, when it's too late, it could have been set up a whole lot better in my best interest. I could have copied what corporations do, but I was just never shown that, or I didn't understand it, so I just said, okay, let's do it. It looks like this is a smart thing to do. But anyway, that's what it comes down to. So I do hope that this video was helpful. If you have any questions, please leave them in the comments below. And as always, I hope this helps.